The drain is no longer a theory. For years, we have watched the COMEX warehouse reports with growing concern. We have tracked every ounce entering and leaving the vaults. We have documented the systematic decline that mainstream analysts dismissed as noise. And for years, the establishment told us not to worry. They said inventory fluctuations are normal. They said the vaults are deep. They said the system has plenty of buffer. But the numbers don't lie. The trend doesn't negotiate. And today we have crossed a threshold that changes everything. Welcome to the market cipher. I'm here to decode what the financial media refuses to acknowledge. This morning, I pulled the latest warehouse stock report directly from the CME Group website. This is not speculation. This is not interpretation. This is the official data published by the exchange itself. And that data confirms what we have been warning about for months. COMEX registered silver inventory has fallen below 90 million ounces for the first time in modern market history. Let that milestone sink in for a moment. The primary pricing mechanism for global silver, the exchange that supposedly anchors paper prices to physical reality, the warehouse system that backs trillions of dollars in derivative contracts. It now holds less than 90 million ounces of deliverable metal. We are witnessing the systematic drainage of the Western silver supply in real time. And today, I'm going to show you exactly why this matters and what comes next. But first, you need to understand why this threshold is so significant. The COMEX has operated for decades as the world's benchmark silver market. When traders reference the silver price, they're referencing COMEX futures. When industrial users hedge their exposure, they use COMEX contracts. The entire global pricing infrastructure depends on one critical assumption, that the paper contracts are backed by sufficient physical metal to satisfy delivery demands. When registered inventory stood at 150 million ounces, that assumption felt safe. At 120 million, it remained comfortable. At 100 million, some analysts started paying attention. But below 90 million, we have entered uncharted territory. We have crossed into a zone where a single large delivery month could theoretically clear a majority of remaining inventory. This is not a drill. This is not a hypothetical scenario. This is the mathematical reality revealed in the exchange's own data. Now, let me explain exactly what registered inventory means, because this distinction is absolutely critical. The COMEX warehouse system operates on a two-tier classification that confuses most casual observers. Understanding the system is essential to grasping the severity of our current situation. The first tier is called eligible inventory. This silver sits in COMEX-approved vaults, but it belongs to private entities. It's their property. They're simply using the vault for secure storage. The exchange cannot touch eligible metal. It cannot be delivered against futures contracts. It remains completely outside the delivery mechanism, unless owners voluntarily convert it. The second tier is called registered inventory. This metal has been warranted and made explicitly available for delivery. When a contract holder stands for delivery, when they demand physical silver, it must come from registered inventory. Here's the insight that mainstream media deliberately obscures. Eligible inventory provides zero buffer for delivery stress. It is not a reserve. It is not a backup. It is private property with no obligation to enter the market. Think of it like an apartment building with a retail store on the ground floor. The apartments upstairs are like eligible inventory. People live there. It's their private space. The store cannot sell the apartments just because they're in the same building. The retail inventory downstairs is like registered inventory. This is what's actually available for customers. This is the only supply that matters for commerce. Reporting total building square footage as available retail space would be absurd. Yet this is exactly what financial media does when they combine eligible and registered silver. The total COMEX inventory exceeds 270 million ounces, but 180 million of those ounces are eligible. They are irrelevant to the delivery equation. The only number that matters is registered, and registered just broke below 90 million. This decline didn't happen overnight. It represents the culmination of a systematic drain that has accelerated dramatically over the past 18 months. Let me walk you through the trajectory so you understand the velocity of this crisis. 24 months ago, COMEX registered inventory stood at approximately 150 million ounces. The system appeared robust. Delivery demands were easily satisfied. The paper game functioned smoothly. 18 months ago, registered had fallen to roughly 130 million ounces. A notable decline, but still within historical comfort zones. Analysts dismissed it as normal fluctuation. 12 months ago, we crossed below 115 million ounces. The pace of decline was accelerating. Delivery demands were consistently exceeding new registrations. The trend became undeniable. 6 months ago, registered inventory broke below 100 million ounces for the first time. We covered this milestone extensively. The warning signs were flashing red. And now today, we have fallen below 90 million ounces. In 24 months, the system has lost 60 million ounces of deliverable supply. That represents a 40% decline. 40% of the deliverable silver supply has vanished from COMEX warehouses in just 2 years. Where did it go? It went to entities who demanded delivery. It went to industrial users who needed physical metal. It went to investors who no longer trusted paper claims. The metal walked out the door because people stopped accepting promises and started demanding reality. Now, let's examine the demand side of this equation. Because supply is only half the story, standing delivery demands have been systematically increasing as registered inventory decreases. This creates a mathematical compression that cannot continue indefinitely. Recent delivery months have seen demands exceeding 50 million ounces. Against a registered base that now sits below 90 million, we're approaching a point where a single delivery cycle could claim more than half of all available supply. Let me frame this in terms that illuminate the absurdity of the current situation. If you ran a business with 90 units of inventory and customers were demanding 50 units every month, how long could you operate? 2 months at most before complete stockout. Now imagine those customers are also accelerating their demands while your suppliers are failing to replenish your shelves. This is the exact dynamic playing out in COMEX silver. The replenishment rate has fallen dramatically below the depletion rate. The inventory trajectory points inexorably toward zero. At current rates of decline, COMEX registered inventory could fall below 60 million ounces within 3 to 4 months. It could approach critical dysfunction within 6 months. We are not discussing theoretical possibilities in the distant future. We are discussing mathematical certainties in the immediate present. Now, some analysts will argue that eligible inventory provides a safety valve. They'll claim that as registered depletes, eligible holders will convert their metal to capture premium prices. This argument misunderstands property rights and market psychology. Eligible inventory belongs to specific entities with specific purposes. Much of it backs ETF holdings where shareholders expect their metal to remain in custody. Some belongs to industrial users who need that silver for manufacturing commitments. They're not storing it for speculation. They're storing it for production. Some belongs to foreign entities who have deliberately moved metal to the United States for safe storage, not for sale. They have zero intention of converting at current prices. Conversion requires voluntary action by owners who may have no interest in selling. You cannot force conversion through exchange mandate. You can only incentivize it through price. And the price required to incentivize mass conversion from eligible to registered may be multiples higher than current levels. This means the sub 90 million registered figure likely represents the actual available supply for the foreseeable future. The eligible buffer is largely illusory. Now, let me explain why this threshold matters beyond just the numbers. Markets operate on confidence. The COMEX silver market operates on the confidence that paper contracts can be converted to physical metal upon demand. As long as registered inventory vastly exceeded delivery demands, that confidence remained unshakable. The paper game could continue indefinitely, but confidence is fragile. It can shift suddenly when participants recognize that musical chairs has more players than chairs. Below 90 million ounces, we enter a psychological danger zone. Sophisticated participants begin calculating odds. They begin considering what happens if others demand delivery before them. Game theory takes over. The rational individual strategy becomes demanding delivery early rather than risking empty vaults later. This recognition can trigger a cascade. Each participant who moves to secure physical metal reduces inventory further. Reduced inventory increases anxiety among remaining participants. Increased anxiety drives more delivery demands. The feedback loop becomes self-reinforcing once critical mass is reached. And we may be approaching that critical mass now. The timing of this inventory collapse intersects with unprecedented demand drivers that show no signs of slowing. Solar panel production continues to explode globally. Every solar installation requires silver. The photovoltaic industry alone now consumes over 200 million ounces annually, and growth projections suggest doubling within 5 years. Electric vehicle production is accelerating. Every EV contains significant silver in its electronics and connections. The automotive sector's silver demand is growing at double-digit rates. Military applications are expanding dramatically. Silver's unique conductivity properties make it irreplaceable in advanced weapon systems, communications equipment, and defense electronics. Medical applications continue growing. Silver's antimicrobial properties drive expanding use in healthcare settings worldwide. These demand drivers are structural. They are not cyclical. They represent permanent increases in baseline silver consumption that mining supply cannot match. Annual silver mining production is approximately 820 million ounces. Annual total demand now exceeds 1.2 billion ounces when industrial, investment, and monetary uses are combined. The market is running an annual deficit exceeding 200 million ounces. That deficit must be filled from existing inventories. And COMEX registered inventory just fell below 90 million. The math is screaming at anyone willing to listen. Supply cannot meet demand. Inventories are depleting. The system is approaching a breaking point. Now, let me address the global context because COMEX doesn't operate in isolation. London Bullion Market Association vaults have experienced parallel drainage. The LBMA, which historically dwarfed COMEX in physical holdings, has seen inventory declines that would have been unthinkable 5 years ago. Shanghai is actively draining Western inventories through persistent premium pricing. The Shanghai silver price has traded above Western prices for months, creating arbitrage flows that pull metal eastward. This premium tells you everything you need to know about relative supply conditions. Eastern markets are bidding above Western markets because they're desperate for physical metal. When Shanghai pays more than New York, metal flows from New York to Shanghai. This is basic economics, and this flow is accelerating. The COMEX sub-90 million milestone occurs within a context of global inventory depletion. Western vaults are being systematically drained to supply Eastern industrial demand. This is not temporary. This is structural, and it represents a fundamental shift in the geography of precious metals that may never reverse. China has become the manufacturing center of the world. China needs silver for that manufacturing. China will pay whatever is necessary to secure supply. Western financial vaults are transforming into supply sources for Eastern factories. The paper claims remain in New York. The physical metal relocates to Shenzhen. This dynamic has profound implications for the long-term viability of Western paper markets. You cannot run a delivery mechanism when the deliverable metal keeps leaving the hemisphere. So what happens next? Let me walk you through the scenario tree that branches from this sub-90 million threshold. Scenario 1 is the slow squeeze. Registered inventory continues declining at current rates. Delivery demands remain elevated but manageable. The system loses 2 to 4 million ounces monthly. Under this scenario, we breach 70 million within 6 months. We approach 50 million within 1 year. The pressure intensifies gradually but relentlessly. Price responds through steady appreciation as the scarcity premium builds. We could see silver reach $50 to $60 within 12 months under this trajectory. Scenario 2 is the acceleration event. Something triggers a rush to delivery, perhaps a geopolitical crisis, perhaps a major financial institution failure, perhaps simply the recognition that inventory is approaching critical levels. Under this scenario, delivery demands spike to 70 or 80 million ounces in a single month. The system cannot fulfill these demands from existing registered inventory. The exchange faces an impossible choice: default on delivery obligations or implement emergency measures that reveal the market's fragility. Either option destroys confidence, price doesn't rise gradually, price gaps violently higher as the paper market disconnects from physical reality. The scenario could see silver reach $100 or beyond within weeks rather than months. Scenario 3 is the controlled demolition. Regulators and exchanges recognize the approaching crisis and implement preemptive measures to manage the transition. Position limits tighten dramatically. Cash settlement becomes mandatory above certain thresholds. New contract specifications reduce delivery optionality. Under this scenario, the paper price becomes increasingly irrelevant as the physical market develops parallel pricing. Premiums at dealers explode. A two-tier market emerges. Sophisticated money migrates to physical ownership, while retail traders remain trapped in paper constructs that no longer reflect reality. All three scenarios point toward substantially higher silver prices. The only variables are timing and volatility. The destination is mathematically determined. Now, here's what I need you to understand about your positioning. If you have been accumulating physical silver, you are not early anymore. You are on time. The inventory collapse we warned about is no longer approaching. It is here. The sub-90 million threshold is not a theoretical level we might reach someday. It is the number published this morning in the official exchange data. Every month of continued drain brings us closer to systemic stress. Every delivery cycle that exceeds new registrations accelerates the timeline. The entities removing metal from COMEX warehouses are not retail stackers buying coins online. They're institutional players moving serious weight with serious analysis supporting their decisions. They have research teams. They have risk managers. They have access to information channels that most retail investors cannot imagine. And they have concluded that securing physical metal now is more important than the convenience of paper positions. When institutions act with this conviction, when they accept storage costs and logistics complications to secure physical delivery, you should pay extremely close attention. So what should you be watching going forward? Let me give you the monitoring framework I use. First, track weekly registered inventory changes. The CME publishes updates daily. Create a spreadsheet. Document the trend. Watch for acceleration in the decline rate. If we start seeing 4 to 6 million ounce weekly declines sustained over a month, the timeline compresses dramatically. The slow squeeze transforms into the acceleration event. Second, monitor delivery notice volumes during active months. When standing delivery demands approach 60% or more of registered inventory, we have entered the danger zone. The market is one large delivery demand away from systemic stress at current levels. Third, watch the spread between COMEX futures and physical dealer pricing. When premiums at major dealers start expanding beyond normal levels, you're seeing physical scarcity manifest in real time. Dealers have pipeline visibility that exchange data doesn't capture. Their pricing behavior provides early warning of supply stress. Fourth, observe eligible inventory movements. If we see significant conversions from eligible to registered, it suggests the exchange is scrambling to replenish deliverable supply. Conversely, if eligible inventory starts declining in parallel with registered, the situation is even more severe than surface data suggests. Fifth, prepare psychologically for volatility. The transition from paper-dominated pricing to physical-dominated pricing will not be smooth. There will be violent swings in both directions. The banks, holding short positions, will attempt to shake out weak hands through coordinated selling. They will deploy their media connections to generate bearish narratives. Do not be manipulated. The warehouse data is the warehouse data. The drain is the drain. Paper prices can be manipulated temporarily. Physical scarcity cannot be printed away. The financial system operates on a foundation of confidence. That confidence rests on the assumption that paper promises connect to physical reality. COMEX registered inventory falling below 90 million ounces represents a crack in that foundation. It is the official confirmation that deliverable supply is diminishing while delivery demands are increasing. This divergence cannot continue indefinitely. Mathematics eventually overwhelms financial engineering. Physical reality eventually pierces paper illusions. You are witnessing the early stages of a monetary metal reclaiming its role as a store of value. You are watching the failure of a fractional reserve paper system that oversold claims against insufficient metal. The reckoning doesn't arrive with a single dramatic announcement. It arrives through the steady accumulation of data points that eventually become undeniable. Today's data point is sub 90 million registered ounces. Tomorrow's data point will be lower still, and the day after that, lower again, until something breaks, until the system resets, until price rises high enough to attract new supply and ration demand. That price is not current price. That price is substantially, perhaps dramatically higher. Position accordingly. Understand that physical metal in your possession exists outside this fragile system. It has no counterparty risk. It requires no exchange to honor a contract. The cipher is clear. The pattern is confirmed. The drain is real and accelerating. This is the market cipher. The warehouse is emptying. The threshold is breached. And the countdown to the next phase has officially begun. Like and subscribe. If you want to continue tracking this drain with analysis the mainstream ignores, share this video with anyone who still believes paper markets reflect physical reality. The 90 million barrier is broken. The question now is how quickly we approach the next threshold, and the next, and the one after that, until the music stops and we discover who actually owns real metal and who owns only paper dreams.